Money. When we think about it, usually numbers come to mind, right? Spreadsheets, maybe budgets, all that math stuff.
Yeah, the technical side.
But, if you've ever felt that weird knot in your stomach checking your bank balance, or maybe that mix of excitement and dread thinking about investing,
Oh, absolutely.
it's way more than just arithmetic. Our choices about money, they aren't always logical, are they? They get tangled up with, like, our emotions, our history, fears, hopes.
Precisely. And that's the fascinating part. The real story of money isn't just in the markets, it's in us, in people, how we behave around it. Financial success, it turns out, isn't just about being smart or knowing formulas.
It's about behavior.
Fundamentally, how you handle yourself when money's involved.
Okay, so that's exactly what we're getting into today. We're doing a deep dive into this human side of money. We're using insights inspired by Morgan Housel's book, The Psychology of Money, based on the source material you brought. Our mission here is to sort of unpack some of those strange, maybe surprising things we all do with money and pull out the key ideas linking our behavior to, well, financial outcomes. So get ready, because you might find that understanding yourself is just as critical as understanding economics.
Okay, let's start unpacking this. It begins with understanding that we each have this, you could call it financial DNA.
Financial DNA, like unique to each of us.
Exactly. Think about it. You grew up in a specific time. Maybe your family had certain values about money. You lived through particular economic conditions. All these unique experiences, they leave a deep imprint.
So our past isn't just like background noise. It actively shapes how we see the whole world of money.
Absolutely. The source really highlights how much those formative years matter. For example, think about someone born in 1970.
Okay.
In their teens and 20s, really crucial years for development, they watched the S&P 500 index go up tenfold.
Wow, tenfold. Okay, yeah. Seeing that kind of growth when you're young, that would definitely make you feel pretty positive about the stock market, probably more willing to invest later on.
Exactly. Now contrast that with someone born, say, in 1950,
Right.
their formative years. The market basically went nowhere for 2 whole decades.
Oof. Yeah, that's a totally different experience.
Totally different. So their financial DNA regarding stocks is likely much more cautious, maybe even negative. They'd probably be less inclined to jump in, no matter how smart they are.
Or take inflation. If you were young during the high inflation of the 70s or early 80s,
You felt it.
yeah, you'd likely have a really strong, probably negative sense of what inflation does to your savings. You'd be very aware of it.
Whereas someone born in the 1990s, they grew up when inflation was pretty low and stable.
So they might understand it intellectually, but they haven't felt it the same way.
Exactly. Their level of concern is just naturally different. It hasn't bitten them personally.
It really drives home the point that everyone's financial decisions, even the ones that look, I don't know, weird or maybe bad from the outside, they actually make perfect sense to the person making them at that time because it fits with their story, their mental map of how the world works.
And this leads right into that great quote from the source attributed to Housel. People do some crazy things with money, but no one is crazy.
I love that. No one is crazy. It's such a key distinction.
It is.
It means because we all have these unique worldviews and there isn't one single right way to manage money that applies to everyone, well, judging someone else's choices as crazy just misses the whole picture.
You're missing their context. They aren't irrational. They're operating based on their unique history, their own narrative.
Yeah. Understanding that probably helps you be less judgmental, maybe even about your own past decisions, too.
Exactly. Now let's shift gears a bit, moving from our personal history to a really fundamental force that works over time, compounding.
Compounding. We hear that term a lot. Interest on interest.
Right, but its effects are often incredibly counterintuitive.
Yeah.
It's powerful, but maybe not always in the way people first think.
Okay, so the source uses Warren Buffett as a prime example here. What's the key insight about his wealth and compounding?
Well, here's the statistic that just blows your mind. $81.5 billion of Buffett's $84.5 billion net worth was actually accumulated after he turned 65.
Wait, hang on. 81.5 out of 84.5 billion after 65.
Yeah, over 96% of his wealth came after the traditional retirement age.
That completely flips the script on how we usually think about wealth building, through those peak earning decades.
It really does. And it highlights a crucial point the source makes. His incredible fortune isn't just because he's a good investor, and obviously he is, he's brilliant.
Right.
It's because he's been a good investor for an incredibly long time. Seriously, he started investing properly when he was like 10 years old.
10. Okay, so longevity is the real secret ingredient for compounding then.
It's the turbocharger. Now think about that ultimate scenario the source lays out. What if Buffett had started later, say age 30, with a decent chunk like $25,000?
More like most people.
Right, and he retired at 60, even if he still managed his amazing 22% annual return.
Yeah.
What would his net worth look like today?
Okay, so still great returns, but less time. I'm guessing much less.
Much, much less. Around $11.9 million.
11.9 million. Okay, that's still a lot of money, obviously, but compared to $84.5 billion?
It's 99.9% less.
Wow, 99.9% less. That difference is almost entirely down to those early years and just sticking with it for so long.
It's the magic of the timeline. And the source contrasts him with Jim Simons, another investing genius. Simons actually has higher annual returns, an incredible 66% since 1988.
66%, that's astronomical.
It is. But his net worth is around $21 billion. Still huge, but way less than Buffett's 84+ billion. Why?
Let me guess. Time
again. Simons didn't really hit his stride with his unique investing approach until he was about 50.
Ah.
So he's had less than half the time for that incredible return to compound compared to Buffett. The source even does this wild calculation. If Simons had Buffett's time frame.
Uh-oh. What number are we talking?
Get ready for it. Something like $63.9 quintillion.
Quintillion? That doesn't even sound like a real number.
Exactly. It's absurd. And that's the power of compounding we're talking about. It's not just bigger numbers. It's results that completely break our intuition over very, very long periods. We just can't underestimate time.
Okay, mind officially blown on compounding. Let's shift gears to something that feels very human, something that often colors our view of finance. Pessimism. Why does bad news seem to stick with us so much more?
Yeah, it's a real bias. It seems like bad things happen quickly, dramatic.
Or a market crash.
Exactly. A 40% drop in 6 months. That's a huge, fast, unavoidable headline. A sudden job loss, immediate pain. These things grab our attention because they're fast and often disruptive.
But the good stuff, like economic growth or steady investment gains, that tends to happen more slowly, incrementally.
Precisely. That 40% drop is a story. But what about a 140% gain spread over 6 years? It feels gradual, maybe doesn't even register day to day as much. Good things often just take time, they build quietly.
Like medical breakthroughs saving lives over decades versus the sudden shock of a plane crash or a natural disaster.
Right. The source mentions this idea of overnight tragedies, but few overnight miracles.
That captures it well. So maybe our brains are just wired to focus on the sudden negative stuff because it feels more urgent, more like a threat.
That's definitely part of it. And money impacts everyone, so sudden financial setbacks are especially potent attention grabbers. But the source asks a really good question here.
Which is?
Does being practical about risks mean you have to be pessimistic all the time?
Ah, good point. You can be aware that bad things might happen without assuming they're the only thing that will happen or even the most likely thing long term.
Exactly. You can be realistic about potential bumps in the road, but still hold on to the belief that over the long haul, the odds generally favor positive outcomes. Progress tends to win out.
So when those scary headlines hit, it helps to zoom out and remember the bigger picture, the longer trend.
Definitely. Remembering that things generally do improve over time can be a useful counterweight.
Okay, let's talk about two factors that often get sidelined when we talk about success, but the source argues are huge: luck and risk.
Yeah, these are like the wind and the waves for a sailboat, as the source puts it. External forces that can dramatically change your course no matter how skilled you are at the helm.
And there's a powerful story used to illustrate this involving Bill Gates.
Right. Bill Gates, Paul Allen, and another friend, Kent Evans, back at Lakeside School in 1968. Gates and Allen were obviously brilliant.
No doubt.
But they also have this incredible, like, 1 in a million stroke of luck. Their high school, Lakeside, was basically the only high school in the world at that time, with access to an advanced teletype Model 30 computer. We're talking tech that even most university grad students didn't have access to.
1 in a million. That's unbelievable luck. And Gates himself acknowledges this, doesn't he? Saying something like, without Lakeside, there'd be no Microsoft.
He's been very clear about it. He knows how incredibly rare and fortunate that opportunity was.
Okay, but there's a flip side to this story involving their friend, Kent Evans.
Yes. The source highlights Kent Evans, who was apparently just as bright, just as the computers, just as visionary as Gates and Allen. He was right there with them, part of that initial group, could easily have been a Microsoft co-founder.
So what happened to Kent?
It's really tragic. Kent died in a mountaineering accident before he even graduated high school.
Oh, wow.
And the source points out the odds of a U.S. high school student dying in a mountaineering accident back then, also about 1 in a million.
Good grief. So you have this 1 in a million piece of good luck for Gates and Allen.
Leading to Microsoft, yeah.
And this equally rare 1 in a million piece of bad luck, pure risk for Kent, cutting everything short.
Luck and risk. Siblings, as the source calls them. Determining outcomes in ways that talent and effort alone just can't explain.
It's a really sobering reminder, isn't it, that success is this complex mix. Talent, hard work, yes, but also these huge, unpredictable outside forces.
Absolutely. It really calls for a dose of humility when we think about our own successes or failures, and maybe more empathy when we look at others.
Okay, let's move to an idea I found really thought-provoking. What money really buys us. The highest dividend it pays isn't necessarily more stuff.
Right. It challenges that standard narrative of just chasing more wealth for its own sake. Housel's view, highlighted in the source, is that the ultimate key to happiness isn't just owning more things.
What is it then?
It's the ability to do what you want, when you want, with who you want, for as long as you want.
Control. Control over your own time.
Exactly. That autonomy.
And the irony is often the pursuit of more money leads people to work harder, longer hours.
Sacrificing that very control.
Sacrificing the control over their time, even as they get richer on paper.
It's a paradox. And research backs this up. Studies consistently find that having a strong sense of control over your life, deciding your schedule, how you spend your days, is one of the most reliable predictors of positive feelings, of well-being.
More so than salary, or the size of your house, or how prestigious your job title is?
Often, yes. Those things contribute. But the feeling of autonomy, of being in the driver's seat of your own life, seems to be incredibly fundamental to happiness.
There's an analogy in the source, isn't there, about a bucket?
Yeah. Try to fill a bucket that has a hole in it. You can keep pouring money wealth into it, but if you don't value and protect your time, plug the hole, that happiness, that well-being just leaks right out. Accumulating wealth without safeguarding your time is kind of ineffective for lasting happiness.
So control over your time. That's the real prize, the highest dividend money pays.
That's the argument, a powerful reframe.
Okay, let's dig into something called tail events, or long tails. What's the core idea here?
The core idea is that in many systems, especially complex ones like finance or business, a very small number of events, rare, outlier events, the tails of the distribution curve, account for the vast majority of the results or outcomes.
So not the everyday stuff, but the really unusual occurrences drive most of the action.
Exactly. And it's often counterintuitive because these events might seem small or insignificant when they happen, or they're just plain rare, so we don't pay them enough attention. But their impact can be massive over time.
The source uses an example from the art world.
Yeah, the art dealer Heinz Berggruen. He apparently acquired huge amounts of art over his career, just constantly buying.
Okay.
And the source suggests that probably 99% of the pieces he bought turned out to be, okay, but not particularly valuable in the long run.
99%. So most of it wasn't a home run.
Not at all. But that tiny fraction, the 1%, the Picassos, the Klees, the Matisses that became world famous and incredibly valuable, those were the tail events. They drove his entire fortune. He could be wrong almost all the time.
And it didn't matter.
It didn't matter because the few times he was spectacularly right paid for everything else many times over.
Wow. Okay, how does that apply to, say, business or investing? Venture capital comes to mind.
Perfect example. A venture capital fund invests in dozens of startups. Most of them will probably fail or just return the initial investment, maybe a tiny bit more.
Right, the failure rate is high.
Very high. But the entire success of the fund usually hinges on just 1 or 2 companies in the portfolio becoming massive outliers, the ones that return 20x, 50x, 100x the investment. Those are the tail events, making up for all the duds.
Or think about a big company like Amazon. The source mentions how in 2018, Amazon alone drove something like 6% of the entire S&P 500's return that year.
One company having that much impact.
And then within Amazon, its incredible growth wasn't from hundreds of successful projects. It was largely driven by maybe 2 huge tail events, Amazon Prime and Amazon Web Services, AWS.
Right. Those massive successes totally dwarf the impact of things that didn't work out, like the Fire Phone or their old attempts at travel agencies.
And Jeff Bezos has talked about this mindset, hasn't he? Accepting failure.
Yeah, there's that quote where after the Fire Phone, which was seen as a big flop, he apparently said something like, if you think that's a big failure, we're working on much bigger failures right now.
Because he understands you need to take big swings, have lots of experiments that don't work.
Exactly. To create the environment where those 1% tail event successes can actually happen, you have to be willing to be wrong a lot.
It's like that stand-up comedian analogy, too. We see the polished Netflix special that's the 1% of jokes that really landed.
The tail event jokes.
Yeah, but we don't see the 99% of jokes they tried out in small clubs over years that just bombed.
Totally. So applying this to investing, the source suggests most people don't really grasp the power of tails. They overreact when individual things go wrong or don't work out.
Instead of accepting that lots of things will go wrong.
Right. If you understand the tails drive the long-term results in business and investing, you realize it's okay for many individual bets or investments not to pan out. It's part of the process that allows the few big winners to emerge and dominate the overall outcome.
Even Buffett's portfolio, right? The source says most of his gains came from just a handful of stocks.
Yeah, something like 10 stocks out of the maybe 500 he's picked over his incredibly long career have generated the vast majority of his wealth.
So even the best aren't right most of the time.
Apparently not. Or at least their success isn't defined by being right all the time. It's defined by the magnitude of their wins when they are right. Being wrong sometimes, even often, is okay if the process allows for those big positive tail events over time.
Okay, let's tackle a really crucial distinction the source makes. The difference between being rich and being truly wealthy. They sound similar, but they're not the same thing at all.
Not at all. Richness is basically about current income and visible spending. It's the stuff you see.
Like the fancy car, the designer watch, the huge house.
Exactly. It's outward display. High income often fuels it, but it's fundamentally about consumption.
But wealth. Wealth is different. Wealth is what you don't see.
Precisely. Wealth is the financial assets you've accumulated, the stocks, bonds, savings that you haven't spent yet. It's money that's working for you, often quietly in the background.
So you could see someone driving a, say, Lamborghini and think, wow, they must be wealthy. But that might not be true at all.
Absolutely. As the source points out, appearances can be super deceiving. That Lambo might be leased or bought with debt. The person might look rich but actually have very little actual wealth, maybe living paycheck to paycheck to maintain that image.
So real wealth isn't defined by the flashy stuff. It's defined by the unspent assets, the savings, the investments.
And crucially, building that wealth requires something that's often invisible too. Self-control. Restraint.
Saying no to spending.
Yes. The luxuries you don't buy, the impulse purchases you resist those acts of not spending are literally what allow wealth to accumulate.
That makes sense. It's easy to find rich role models because their spending is loud and visible.
You see it everywhere.
But true wealth is hidden. The behavior that builds it, saving, being disciplined, delaying gratification, is much harder to see and therefore harder to imitate.
We're sort of conditioned to think, if you have money, you should spend it to show it. But the source really hammers home that the key to building wealth is actually counterintuitive to that. It's saving and investing.
Yeah.
The only way to be wealthy is to, well, not spend all the money you have.
So, lesson learned, don't judge wealth by appearances. The real engine is that quiet discipline, self-control, saving, building assets, investing for the future.
Couldn't have said it better.
Yeah.
Now, speaking of investing, let's talk about its real price. People often seem to approach the stock market like it should be free, like they should get returns without any cost or risk.
Trying to get something for nothing.
Yeah, exactly. The source uses a mountain climbing analogy. You want the amazing view from the summit, right?
Yeah.
But you accept there's a price. The hard physical climb, the uncertain weather, the risk involved. You don't expect a golden escalator to just whisk you to the top.
Right, that would be absurd.
Yet with investing, people often want the summit, the long-term market returns, but they try to avoid the climb, the price, which is the volatility, the uncertainty, the fear along the way.
The source also had that car analogy.
Right. You can buy a brand new car, high price, maybe higher potential reward, like aiming for those, say, 12% average market returns.
Okay.
Or you can buy a used car, lower price, probably less potential reward, maybe like safer bonds giving you 4%.
Cheaper, less risk, less potential upside.
Or you can try to steal a car.
Yeah.
get the car for absolutely nothing.
And trying to perfectly time the market, jumping in right at the bottom and out right at the top. That's like trying to steal the return.
Exactly. It's trying to get the gains
Yeah.
without paying the required price, which is enduring the volatility and uncertainty, staying invested through the inevitable ups and downs.
Think about the Dow Jones average return the source mentioned, like 11% annually from 1950 to 2019. That sounds great on average.
Fantastic long-term average.
Yeah.
But it definitely didn't happen in a smooth, straight line. The source emphasizes just how many dramatic crashes and euphoric peaks happened within that period.
And those swings, that volatility, that's emotionally tough. It makes people want to bail out, right?
Yeah.
To avoid the discomfort.
Absolutely. But here's the key insight. That emotional discomfort, the fear when markets plunge, the uncertainty about what happens next, that is the price you pay for earning those long-term returns.
It's not just dollars and cents, it's an emotional toll.
It's an emotional and psychological price. And the source argues that successful investing isn't just about picking the right things. It's about acknowledging that this price exists and be willing to pay it.
Accepting it as part of the deal.
Exactly. And maybe reframing it. It's not a fine for doing something wrong. It's more like an admission fee.
An admission fee.
Yeah, the fee you pay to access the potential long-term growth that markets can offer over time. Once you identify that fee, accepting volatility, uncertainty, fear, you can then consciously decide if you're willing to pay it to get the potential reward.
That's a helpful way to think about it. Okay, let's wrap up with one final really critical concept for financial well-being, maybe even life well-being. Knowing when enough is enough.
Yes,
Yeah.
escaping the treadmill. This gets at the idea of the hedonic treadmill or hedonic adaptation.
Which is?
Basically, our tendency to constantly adjust our expectations upward after we achieve something. You hit a goal, feel good for a bit, but then that becomes the new normal, and you immediately start striving for the next thing. Enough keeps moving further away.
And you see this even with people who have achieved unimaginable wealth, right? The source mentions examples like Bernie Madoff or Rajaratnam.
Yeah, individuals who were incredibly, obscenely wealthy by any objective measure, yet they still resorted to massive fraud and crime.
Why?
Because enough was never enough for them. The goalpost just kept moving endlessly. That relentless pursuit without any internal sense of, okay, this is sufficient, becomes like climbing a ladder with no top rung.
It just consumes everything else, including happiness and fulfillment.
It really can. No matter how much you accumulate, if you don't have that sense of enough, that feeling of needing more can just gnaw away at you.
So the final piece of the puzzle isn't just about accumulation, it's about definition. Defining what enough actually means for you.
Based on your own needs, your values, what truly brings you that sense of control and well-being we talked about earlier.
It's about consciously deciding to step off that never-ending treadmill.
It's a crucial, though often overlooked, part of the psychology of money.
Wow. Well, this deep dive has certainly made it clear. While the numbers matter, financial success seems to be so deeply intertwined with understanding our own human psychology, our behaviors, our biases, our history.
Absolutely. We've touched on how our past shapes our unique financial DNA, the almost unbelievable power of compounding over very long stretches of time, why we tend to lean towards pessimism even when progress happens.
Right, and the huge, often unseen roles of luck and risk and outcomes. And that powerful idea that the best thing money can buy might actually be control over your own time.
Don't forget the impact of those rare but decisive tail events, the important difference between visible richness and hidden wealth, and understanding that investing comes with an emotional price tag that you just have to be willing to pay.
It all circles back to our behavior, our emotions, how we manage ourselves around money.
Hopefully, exploring these ideas offers you, the listener, some fresh perspectives on your own relationship with money.
Definitely. So as you think about your own financial life, maybe consider this. How does understanding this human side, your own history, your biases, the role of chance, what enough and well-being truly mean to you beyond just dollars? How might that change the way you approach your goals and handle the inevitable emotional ride that comes with managing money?
That's something worth pondering.